Well, the S&P 500 exiting the bear market territory, driven largely by tech. One of the top performers in the sector, of course, is Nvidia, the chip giant, up more than 150% so far this year. Our next guest says the stock is overvalued after this run. Joining us now is Morningstar Chief U.S. Equity Strategist David Sekera. David, you're certainly in the minority among some of the analysts that we've spoken to who said there's still more upside with Nvidia. I'm curious to get your take on where Nvidia trades at right now, because there is the argument, and I'm sure you've heard it, that things are a little cheaper actually when you think about the outlook for Nvidia and the upside that we see.
So right now we rate Nvidia with 2 stars, which means that we think it's overvalued. It's currently at about a 30% premium above our $300 fair value estimate. And again, we have a very positive outlook on the company. It's just a matter of we think that the valuation has just gotten ahead of itself, at this point in time. And when I look at our projections, I don't think that we're necessarily being especially conservative. We are looking for a 50% increase in the top line this year. And in fact, when I look over the course of the next 5 years, we're projecting revenue to grow at a compound annual growth rate of 23%. So essentially taking it from $27 billion in revenue, in 2023 to $76 billion in 2028. At the same point in time, we're also bringing our operating margins up, essentially doubling them to about 50%. Over the past 5 years, they've averaged 28.7. So essentially, we're taking our EPS growth rate, from $3.34 in 2023 all the way up to $16.29. Essentially, people are paying 23.6 times 2028 earnings right now. So again, while we're very positive on the underlying fundamentals, I think it's just the valuation has just gotten ahead of itself.
David, do you also think that more broadly when it comes to so many of these names that are associated with AI, this AI-fueled rally, is that overdone across the board, or is this more specific to NVIDIA's massive run-up that we've seen?
Well, in this case, I do think it is very specific, to Nvidia. We do still see some other opportunities out there for investors. Taiwan Semi would be one that I would highlight that I think is good for people to take a look at. We do still think that there's, additional upside there. But, I do think that we're going to see a lot more competition, in this space. They're just generating too much revenue growth, too high margins. Granted, they do have first mover advantage right now, but with those kind of margins, it's just going to be attracting more and more competition over the next couple of years, and competition not just from the other chip makers, but also from some of the users. So Microsoft, Alphabet, Amazon, all moving into this space, trying to design their own chips as well.
Let's talk about another sector that you're watching that you may not like as much, and we're talking about the energy sector. Obviously, the biggest winner last year certainly hasn't performed to the level that we saw in 2022. Hess is one that you've highlighted. Why?
Well, it's almost a similar story in that, we're very positive on the underlying company and the fundamentals, but we do think that the valuation has just gotten ahead of itself. So we rate this company or the stock with just 1 star. It trades at a 60% premium over our $84 fair value estimates. Company does have, some of the best assets in the space, great growth prospects, but the valuation has just gotten ahead of itself too much. So I talked to our energy analyst, and some of the metrics he was looking at, enterprise value to EBITDA. The stock's trading, above 9 times right now. The next closest competitor is about 6 times. So our fair value estimate would actually still put, a higher valuation on the company at 7 times, but certainly lower than where it's in the marketplace today. And I'd also note too that, we do think oil prices will remain relatively high over the next year or two. We're looking for oil at $72 a barrel on average this year, dropping then to $66 a barrel next year. But when we look at our long-term supply and demand forecast in conjunction with, the cost of production, we do think over time that, oil prices will continue to keep coming down. A long-term target on oil is $55 a barrel.
David, let's move on to some of the names that you do like. One of those, AT&T. It's actually been off, just about 13% since the start of January. Telecoms haven't exactly been in favor here amongst investors. What do you see as the catalyst for AT&T?
Well, what I like about AT&T right now is I think that stock is at the intersection of being a deep value play, and with as much as growth has run up thus far this year, I still think that the value in the market now is going to be in the value space and communications. And again, the communications sector is the most undervalued sector, in our view, at a 20% discount to fair value. So when I look at AT&T, it's currently rated 5 stars, which is our highest rating, trades at a 36% discount to our $25 fair value. And our fair value estimate, when I look look at some of the metrics, that's an 8 times enterprise value to EBITDA, a 7% free cash flow yield. So again, not very stretched multiples, in my mind. I look at the stock, it's paying a 7% or about a 7% dividend yield. And we do think fundamentally the company is in a relatively strong position. We rate the company with a narrow economic moat, which means that we do think they have long-term, structural cost advantages.
What does that moat look like? I mean, when you highlight in your notes that there's only 3 players really when you talk about the wireless space right now. What makes AT&T's moat particularly strong?
Well, there's a couple of things going on here. So one, we do have the merger now between T-Mobile and Sprint with only 3 major players in the market. We do expect that going forward, pricing in the cell phone business and the wireless business should be much more rational going forward. But some of the other things I like here is that, in 2020, they did bring a new CEO on, and he's been taking a lot of corporate actions really to unlock shareholder value. So he's been doing a number of things strategically to reposition the business, make sure that they're going to be able to address the ongoing evolution within the telecom sector. But then he's also been refocusing the company strategy. We thought it was a good move to spin off, Warner Media. He also sold a stake in DirecTV. So we do think that, as he's refocusing on that core business, stepping up investments in both the wireless, and the fixed line networks, that CapEx spending will pay off for shareholders over time.
David, you also see some opportunity in a regional bank name, U.S. Bancorp, and this comes at a time when many investors are a little bit nervous to touch this sector. Why do you think U.S. Bancorp is better protected amongst some of those risks out there for regionals?
Yeah, I mean, overall, it looks like the regional banks have been in kind of that bottoming out stage, and this is probably our best pick in the regional area. So it's also rated 5 stars, trades at a 38% discount to our $53 fair value. We do believe that they do have a wide economic moat, and we also believe that the uncertainty there would be more of a medium rating, and again, also pays a 7% dividend yield. So when we think about the regional banking business model overall, yes, it's definitely under stress here in the near term, but it's not broken. And one of the things about U.S. Bank is that, they are larger than the typical regional bank. And I suspect that they're going to see, less deposit flight. In fact, if you look at the first quarter earnings, I think they only saw, 4% of deposits, leave. And I think that over time, they're just going to have some of the better earnings leverage out there. So when I look at our model, we're looking at for the long term, 15% returns on tangible common equity, well above 9% cost of capital. And that puts it, in the higher end of our regional bank coverage.
Morningstar Chief U.S. Market Strategist David Sekera, it's good to have you on today. Appreciate the time.